So how does a commercial plumbing company post like record cash flows and its lowest debt ever right in the middle of a global supply chain crisis?
Right, and a commercial real estate slump too. I mean, it's kind of wild.
Yeah, exactly. It makes no sense on paper. But today, we are tearing into the Q4 2025 earnings transcript from Zurn LK Water Solutions. Ticker symbol is ZWS.
Good old ZWS.
Right. And if you're holding this stock, or even just looking at the industrial sector in general right now, the macroeconomic environment is flashing all sorts of warning signs.
Oh, absolutely. It's rough out there.
I mean, housing starts are incredibly volatile. Inflation is sticky. Interest rates are making borrowing just ridiculously expensive.
Yeah, cost of capital is a real issue for a lot of these legacy companies.
Totally. Yet somehow, this company just printed a quarter that looks completely detached from that reality. Like they're operating on a different planet.
They really are. And, the contrast is what makes this specific transcript so compelling to me. Well, when you read through most industrial earnings calls right now, the executives, they basically spend the first 20 minutes making excuses.
Oh, always. It's a blame game.
Right. Yeah. Like they blame the Federal Reserve, they blame commodity super cycles, labor shortages, you name it, they blame it.
Yeah, the classic macro headwinds excuse.
Exactly. But reading the Zurn LK transcript, it was just entirely focused on execution. There was no whining. They aren't just surviving a tough macro environment. They are actively expanding their profit margins.
Which is the holy grail right now. But our mission today on this deep dive is to break down exactly how they did it. We are cutting through all the Wall Street corporate jargon to give you, the retail investor, a really data-forward, plain language analysis.
Because that's what matters, not the spin, the actual numbers.
Right. We're going to hit the headline numbers, the operational story driving them, management's future guidance, and then what it all means for your portfolio. So to understand if this is sustainable, we really have to look under the hood. Let's start right there with the headline numbers.
Yeah, let's get into the Q4 data.
So looking at the transcript, sales hit $407 million for the quarter.
Which is huge.
It is. And that represents a 10% core and reported growth year over year. But I want to pause right there.
Okay, what's the flag?
Well, a 10% top-line growth figure can be highly, highly deceptive in an inflationary environment.
Oh, for sure. It can totally mask what's actually happening.
Right, because we've seen plenty of companies boast about double-digit revenue growth over the last 2 years, but when you dig into the actual volume, they are shipping fewer physical products.
They just jacked up the prices.
Exactly. They just raised prices to cover their own exploding costs.
Yeah.
So looking at this 10% for ZWS, is this actual organic demand? Or is this just, price gouging masking a stagnant business?
That is the exact right lens to view top-line revenue through right now. You have to ask that question. And the CFO, David Pauly, he actually addressed this directly on the call.
Okay, so what's the breakdown?
The 10% growth is actually a mix, and the split is crucial. About 5 points of that price growth in Q4 came directly from previously announced tariff-related pricing actions.
Wait, hold on. So fully half of that top-line growth is just them passing along costs to the end consumer.
Yes. Half of it is price.
Okay, well, that changes the narrative quite a bit, right? I mean, it's not that demand is suddenly surging 10%. It's that prices are up 5% and volume makes up the rest.
True, but we really shouldn't view that 5% price increase as a negative thing.
Really? Why not? Because as a consumer, I hate price hikes.
Sure, consumers hate it. But as an investor, in corporate finance, the ability to pass on a 5% price hike without losing your customer base to a cheaper competitor, that is the ultimate stress test of pricing power.
Oh, I see what you're saying. If they raise prices and people still buy it, it means they have to buy it.
Exactly. If Zurn Elkay raises the price of a commercial water filtration system and the building manager still buys it instead of going with a generic knockoff, it proves the product is sticky.
They aren't selling commodities.
Right. They are selling essential, highly specified infrastructure. And the fact that the other 5% of that growth came from actual volume demand, meaning they physically shipped more units, that's a very strong indicator of market share capture, especially while parts of the construction market are totally stalling out.
Okay, that makes sense. So they have pricing power and real volume growth.
Yeah.
But top-line revenue is kind of the vanity metric, right? Let's look at what they actually kept in their pockets.
Yeah, let's talk profitability.
Their adjusted EBITDA, which Just a quick reminder is earnings before interest, taxes, depreciation, and amortization that grew 14% to $104 million.
A really solid beat.
Definitely. And the transcript specifically highlights that margins expanded by 100 basis points to 25.6%.
Okay, we need to pull that apart for a second because margin expansion of 100 basis points is like one of those classic phrases Wall Street analysts throw around that just completely obscures the actual physical reality of a business.
It sounds so technical and dry.
Right. A basis point is literally just 0.01%. So 100 basis points equals exactly 1 full percentage point.
Okay, so their margin went up 1%. What does that actually mean on the factory floor? And more importantly for you, the shareholder.
It means that for every single dollar Zurn LK generates in sales, they are keeping a full extra penny of pure profit compared to the exact same quarter last year.
A penny on a dollar. I mean, that sounds kind of trivial when you say it like that.
It does sound small, but when you apply that extra penny to $407 million in a single quarter, it translates to massive wealth creation.
Oh, right, because it scales.
Exactly. It proves a real decoupling of revenue or costs. When your profit growth, which was 14%, is actively outpacing your revenue growth, which was 10%, it means you are operating fundamentally more efficiently. You aren't just working harder, you are working smarter.
But let me push back on that margin expansion for a second, because sometimes companies achieve that by doing things that are just terrible for the long-term health of the business.
Like what?
Like they fire a bunch of essential staff, or they slash their research and development budget to zero, or they defer maintenance on their factories. They basically squeeze the business dry to make the current quarter look brilliant, but then the wheels fall off a year later.
Ah, yeah. Eating the seed corn.
Exactly. Eating the seed corn. Do we see any evidence in the transcript that they are just starving the business to pump up these margins?
It's a critical danger to watch out for, but the transcript provides a very, very clear counter indicator to that, and you find it right in their cash flow statement.
Because cash doesn't lie.
Right. You can manipulate earnings to some degree with accounting tricks, depreciation schedules, whatever, but free cash flow is physical reality. In Q4 alone, Zurn LK generated $83 million in free cash flow.
Wow, in one quarter.
Yeah, that brought their full year 2025 total to $317 million, which is a 17% jump from 2024.
Okay, so that debunks the starving the business theory.
Completely. If they were deferring maintenance or starving the business, you would typically see friction in their working capital. You'd see inventory piling up in warehouses or unpaid bills. Instead, they are converting an incredibly high percentage of their net income straight into cold, hard cash.
Which brings us to the balance sheet.
Yeah.
Because all that cash has to go somewhere, right? The transcript notes that their net debt leverage plummeted to 0.4 times.
Which is incredible for an industrial.
It's their lowest debt level ever as a public company. And with that cash, they repurchased roughly 3% of their outstanding shares over the year. They spent about $160 million doing that, paying an average price of $36.74.
And they paid a dividend on top of that.
Right, $64 million in dividends. But let's pause on the buybacks. You hear the phrase shrinking the float on financial news all the time. Let's break down the actual mathematical mechanics of what happens to my position if I'm holding 100 shares of ZWS and the company buys back 3% of the total float.
Okay, the easiest way to visualize shrinking the float is to think of the entire company's future profits as a massive pizza.
I love a good pizza analogy.
Right. So if there are 100 slices of pizza and you own one slice, you are entitled to 1% of all the profits the company ever makes.
Okay, simple enough.
When management takes $160 million in cash and buys back 3% of the outstanding shares on the open market, they literally retire those shares. They destroy them.
They throw the slices away.
Exactly. So now the pizza is only cut into 97 slices. You didn't buy anything new, you didn't do any extra work, but your single slice just mathematically represents a larger overall percentage of the entire pie.
So my claim on that $317 million of free cash flow just got bigger without me lifting a finger.
Exactly. Your earnings per share goes up purely through financial engineering. And when a company combines a 3% reduction in share count with a growing dividend, they are employing a dual-engine approach to shareholder returns. It's highly defensive.
Okay, so the headline numbers are remarkably clean, generating $317 million in free cash flow. Sounds great on paper, but as we noted at the top of the show, we are currently sitting in a really difficult macro environment.
Very difficult.
Mortgage rates have heavily impacted new construction. People aren't building like they used to. So I'm looking at these margins, I'm looking at this cash, and I have to ask, who is actually buying these physical products right now to drive this kind of performance?
And to answer that, we really have to look at their end market mix. Management was very transparent on the call that they faced a tough residential housing market.
Which is obvious. Nobody is building massive tracts of single-family homes at the rate they were 3 years ago.
Right. Furthermore, they acknowledged pockets of real weakness in commercial real estate. Office space construction is largely stalled out in major metropolitan areas.
Which makes total sense. If no one is building 50-story office towers downtown, no one needs to install 50 stories worth of commercial plumbing and water fountains. So how do they dodge that bullet?
Because they strategically position themselves to capture demand in non-residential institutional markets.
Institutional? Meaning what exactly?
We're talking about schools, universities, hospitals, and government facilities. They were able to completely offset the residential and commercial softness with incredibly strong growth in these institutional sectors.
Let's explore the mechanics of that demand. Because institutional spending operates on a completely different psychological and financial frequency than, like, residential real estate.
Oh, night and day.
If I want to build a house, I look at the current 30-year fixed mortgage rate. And if it's hitting 7 or 8%, I wait. It's a highly elastic, interest rate dependent decision.
Right. You just put the plans on hold.
But a hospital doesn't operate like that.
Precisely. Institutional demand is largely insulated from the immediate whims of the Federal Reserve. Like, a hospital facility manager doesn't delay upgrading a failing water filtration system in the oncology wing just because interest rates ticked up 0.25%.
The need is absolute. People need clean water.
Exactly. Similarly, public schools are often funded by municipal bonds that are approved years in advance by voters.
Oh, that's a great point. The money is already sitting there.
Right. Once that bond money is allocated for infrastructure upgrades specifically for safe drinking water in schools, that capital is going to be deployed regardless of what the broader macroeconomy is doing. By weighting their sales heavily toward these institutional clients, Zurn Elkay has built a massive defensive shield around their revenue.
But securing the right customer base is only half the battle, right?
Yeah.
You still have to manufacture the physical product. And this is where the transcript gets genuinely fascinating to me.
Oh, the supply chain stuff?
Yes. Management talked about executing the supply chain optimization plan. Specifically, they are actively exiting direct material purchases from China.
It's a huge move.
The timeline they gave is aggressive too. They said they are on track to have only a few points of cost of goods spend coming from China by the end of 2026.
And we really need to unpack the logistics of this, because moving a supply chain is not like changing your internet provider. It is incredibly painful.
For the last 2 decades, the absolute standard operating procedure for industrial manufacturing was to offshore as much as physically possible to China, right?
Yeah, exploit cheaper labor and raw material costs.
Yeah.
Those supply chains are deeply, deeply entrenched.
Wait, this is exactly where I need to push back. Moving a 20-year entrenched supply chain out of China usually results in massive near-term capital expenditures and severe operational disruptions.
Yes, historically that's very true.
You have to find new factories, build new tooling, conduct new quality assurance audits, establish entirely new shipping routes. How are they doing this without bleeding cash and crushing those margins we just spent 10 minutes praising?
It's an excellent question, and frankly, it's the reason many companies simply refuse to leave China despite the geopolitical risks. The switching costs are just terrifying to management teams.
So how is ZWS pulling it off?
Well, based on the commentary in the call, they are executing a highly phased transition. They aren't doing it blindly overnight. They are utilizing nearshoring, likely moving production to Mexico or back domestically, and they are dual sourcing during the transition.
Dual sourcing?
Yeah, that means they don't turn off the factory in China until the new factory in North America is already producing at an acceptable quality standard. They run them side by side for a bit.
Okay, so they run parallel systems to avoid a stockout. But that still costs money. Paying 2 factories instead of 1, why go through the headache at all?
Because the geopolitical calculus has fundamentally changed over the last few years. This isn't a public relations stunt about bringing jobs home. It is a hard-nosed structural margin defense.
Margin defense from what?
Tariffs. The CFO stated explicitly that exiting Chinese direct materials secures a positive dollar price cost impact from tariffs.
Let's break that down for the listener. Tariffs are essentially a tax paid by the importing company at the border.
Correct. It's not paid by China, it's paid by the American importer.
So if a competitor of Zurn LK is importing raw brass or finished valves from China, and the government suddenly slaps a 25% tariff on those goods, that competitor has a terrible choice to make.
A lose-lose situation.
Right. They either absorb the 25% cost, which completely wipes out their profit margin, or they pass that 25% price hike onto the customer, which risks driving the customer away.
Exactly. Tariffs introduce massive, unpredictable volatility into a business model. By ripping their supply chain out of China, Zurn LK is effectively buying an insurance policy against geopolitical trade wars.
They're insulating themselves.
Right. If new tariffs are announced tomorrow, Zurn LK's competitors will be scrambling in the boardroom trying to figure out how to survive the margin crush. Zurn LK, on the other hand, is completely fine. Their costs are locked in, they're closer to home, and they are immune to the stroke of a pen in Washington or Beijing.
So they have the institutional customer base, and they've totally de-risked the supply chain. That's a great setup. But let's look at the actual product innovation, because the product itself still has to drive the volume.
True, you can't just sell financial engineering.
Right. The transcript spent significant time highlighting the launch of their new Filtration line. And looking at the specs, they aren't just tweaking an old model.
No, it's a major upgrade.
They've engineered a top-mount access point that allows for a 30-second filter change. The capacity is bumped up to 10,000 gallons. And crucially, these filters are designed to capture the full family of PFAS alongside microplastics and lead.
And the inclusion of PFAS, the so-called forever chemicals, is the absolute key differentiator here.
Explain why that matters so much right now.
Because the chemistry of water filtration is complex. Standard cheap carbon filters might make water taste slightly better by reducing chlorine, but they often really struggle to capture advanced synthetic chemicals like PFAS.
And PFAS are everywhere in the news right now.
Exactly. They don't break down in the environment, they don't break down in the human body. By engineering a commercial-grade solution that reliably captures these specific, highly publicized contaminants, Zurn LK is tapping into a massive wave of public health anxiety.
Facility managers, school boards, corporate offices, they are all facing immense pressure to guarantee safe drinking water.
And they have the budgets to pay for it.
But, the genius here isn't just the chemical engineering of the filter itself. To me, it's the mechanical engineering of the business model.
The razor and blades.
Yes. Let's talk about the razor and blades model.
Yeah.
This is the oldest trick in the book, popularized by Gillette way back in the day. You sell the razor handle for incredibly cheap, or even take a loss on it, because the razor handle only fits your specific proprietary razor blades.
And the customer has to buy those blades forever.
Exactly. How is Zurn LK applying this classic model to commercial plumbing?
They are applying it flawlessly. When Zurn LK installs a Filtration water fountain in, say, an airport corridor or a middle school hallway, that physical unit, the metal fountain itself, is the razor.
Right, a permanent fixture.
But the transcript explicitly notes they designed these units with proprietary filter heads. You can't just go to a big box hardware store, buy a generic, cheap $10 water filter, and screw it into a Zurn LK fountain.
It won't fit.
It absolutely won't fit. The threading, the locking mechanism, the physical housing, it is entirely proprietary.
So once that fountain is bolted to the wall and plumbed into the building, the facility manager is locked in.
Contractually and functionally.
Right, because to ensure the water is actually free of PFAS and lead, they are obligated to buy Zurn LK's specific replacement, filters the blades on a regular schedule.
And consider the 30-second filter change feature they highlighted on the call. Why does a 30-second change matter to an investor?
I guess it's convenient.
It's more than convenience, because in a large facility like a massive university, labor costs are a huge line item. If a maintenance worker has to shut off the main water valve, use 3 different wrenches, and spend 20 minutes wrestling with a filter housing that's leaking all over the floor, the facility manager is going to avoid changing those filters as long as possible.
Oh, I see. They'll stretch a 6-month filter to 12 months just to save the hassle.
Exactly. But by making the process take 30 seconds with a simple top-mount twist and lock mechanism, they remove all the labor friction.
The easier it is to change, the more frequently the building manager will actually adhere to the recommended replacement schedule.
Which means they buy more filters. And that transforms the fundamental revenue profile of Zurn LK. Historically, industrial manufacturers rely on cyclical one-time sales.
Right. You build a building, you buy the pipes, you buy the fountain, and then the manufacturer never sees you again for 20 years.
Exactly. But the proprietary filtration model converts a cyclical construction business into a highly predictable recurring revenue machine. Every time they sell a new fountain, they are planting a seed that generates a high-margin annuity stream of filter sales for the next decade.
It's basically a built-in physical subscription model for clean water.
That's exactly what it is.
But executing that kind of proprietary engineering, while simultaneously moving an entire supply chain out of China, requires intense internal coordination. Like, how does a company with thousands of employees actually pull that off without dropping the ball everywhere?
The answer, according to the transcript, lies in their corporate culture, specifically something they call ZEBS, the Zurn LK Business System.
ZEBS. Okay. This is where we transition from financial engineering to human engineering.
Yeah, and a lot of companies have these branded internal management systems, right?
Totally. Usually they're just empty corporate buzzwords plastered on break room posters. Yeah. Synergy, paradigm shift, whatever.
Exactly. But Todd Adams, the CEO, spent a significant amount of the call detailing the actual metrics behind ZEBS. It is deeply rooted in the concept of continuous improvement, which originally stems from the Japanese manufacturing philosophy of Kaizen, popularized by Toyota.
And the numbers they shared regarding this continuous improvement culture were staggering.
Really impressive.
They have an internal system where employees submit ideas to improve operations. From a base of roughly 2,500 employees, they received 5,568 continuous improvement submissions in 2025.
That is a 49% increase in a single year.
Let's contextualize what a continuous improvement idea actually looks like on the factory floor, though, because it's rarely some massive million-dollar technological breakthrough.
No, it's very granular. It's a worker on the assembly line realizing that if they move the bin of brass fittings 3 feet to the left, they save 4 seconds of walking per unit assembled.
And 4 seconds sounds completely meaningless to an outsider.
It does. But if that assembly line produces 5,000 units a day, those 4 seconds compound into hundreds of saved labor hours over a year. Or it's a shipping clerk realizing that a specific packaging configuration reduces cardboard waste by 2%.
It's the aggregation of marginal gains.
Exactly.
When the CEO talks about trying to make the company 1% better every day, getting more than 2 proactive, efficiency-driving ideas from every single employee is the physical manifestation of that goal.
Right. And remember that 100 basis point margin expansion we discussed in the headline numbers?
The extra penny on the dollar.
Right. It isn't magic. It's the mathematical result of 5,500 tiny improvements compounding on top of each other.
And crucially, creating an environment where a factory floor worker feels incentivized to submit an idea and actually sees management implement it.
Mm-hmm.
That requires a level of operational discipline that most standard corporate structures entirely fail to achieve.
Most workers would just keep their heads down.
Right. It proves that the efficiency at ZWS is structural. It's not just a temporary stroke of luck.
Okay, so to synthesize the story behind the numbers here, we have a company heavily weighted toward resilient institutional buyers. They've insulated their margins by tearing their supply chain out of China to avoid tariffs.
Yep.
They've engineered a proprietary razor and blades filtration system for recurring revenue, and they have an army of employees hyper-focused on daily efficiency.
It's an incredibly strong foundation. I mean, the story holds up.
Yeah.
But, the stock market is a forward-looking mechanism.
Yeah.
It prices in the future, not the past.
Always.
So what exactly is management projecting for 2026? Because they can't rest on 2025's laurels forever.
Management laid out a very specific guidance playbook for the future.
Mm-hmm.
For the full year 2026, they are projecting mid-single-digit core sales growth. And they expect that free cash flow to step up even further, targeting $335 million.
Okay, steady growth.
Furthermore, they gave analysts very precise targets for the first quarter of 2026. They expect core sales to be up 7 to 8% year over year, with EBITDA margins expanding again, hitting somewhere between 25.5 and 26%.
But there is a very specific piece of financial jargon in the guidance section that we really need to stop and decode.
Let's do it.
Management guided for 35% incremental adjusted EBITDA margins on increased sales. If I'm a retail investor listening to this transcript while driving to work, my eyes probably glaze over at that phrase.
It's a mouthful.
What is an incremental margin, mechanically speaking?
This is arguably the most important metric for understanding the scalability of a business. Incremental margin measures how much of every new dollar of revenue turns into pure profit.
Okay, give me an analogy.
Let's use a restaurant analogy. Imagine you own a high-end restaurant. You have to pay your monthly rent, you have to pay the electricity bill, and you have to pay the head chef's salary regardless of whether one person walks in the door or 50 people walk in.
Right. Those are your fixed costs. The doors are open, the lights are on. You're bleeding money until people buy food.
Exactly. So if it's a slow Tuesday night, you're losing money because your fixed costs are eating you alive.
Makes sense.
But let's say on a Friday night, the restaurant is packed. Your fixed costs, the rent, the lights, the chef, they are already completely paid for by the first 50 customers.
Okay, the break-even point is hit.
Right. If customer number 51 walks through the door and orders a $50 steak, the only new cost to you is the physical raw meat and maybe a bit of butter.
So almost the entire $50 from that steak drops straight to my bottom line as pure profit.
Exactly. That is a high incremental margin.
Okay, so applying that to Zurn Elkay, when they guide for 35% incremental margins, it means that for every single additional dollar of sales they generate in 2026 above their baseline, 35 cents will fall straight through to operating profit.
You nailed it. Because their fixed costs, the massive factories, the corporate headquarters, the executive salaries are already completely covered by their existing revenue base.
So they don't have to scale their expenses at the same rate they scale their revenue.
Exactly. As they grow the top line, they don't have to build an entire new factory to handle a 5% increase in orders. The infrastructure is already there and fully funded. Therefore, a massive chunk of that new revenue bypasses the expense column and becomes profit.
That is immense operational leverage. And during the Q&A portion of the call, one of the analysts actually pointed out that they hit a 42% pull-through rate last year.
And pull-through is just another term for that incremental flow.
Right. So guiding for 35% when they just achieved 42% suggests management is being wonderfully conservative here.
They are definitely sandbagging a bit.
They are setting a bar they absolutely know they can clear.
Which is exactly what you want to see as an investor. Underpromise and overdeliver. But they aren't ignoring the macro realities in their 2026 outlook.
Right. They laid out the tailwinds and the headwinds very clearly.
Yeah. They expect the institutional and waterworks markets to provide low single-digit growth. They expect the commercial real estate market to remain completely flat. And they are fully bracing for the residential market to remain a tough environment.
Pragmatic.
They also noted that the pricing impact, that 5% hike we discussed earlier, will be more pronounced in the first half of 2026. Then it will kind of taper off as they start comparing against the back half of 2025 when those price hikes were already baked into the system.
Let's talk about risk, though, because everything sounds a little too rosy right now.
Fair enough. Where's the crack in the armor?
During that same Q&A, an analyst brought up a major red flag that could totally derail these beautiful 35% incremental margins. They asked about the rising cost of metals, specifically copper.
Ah, yes, the copper supercycle.
Right. Copper prices are experiencing a massive surge globally, driven by everything from electric vehicle production to grid infrastructure upgrades for AI.
Everyone needs copper.
Exactly. And Zurn Elkay is a commercial plumbing company. They use a massive amount of brass and copper in their valves, their fixtures, their heavy-duty piping. If the raw material costs explode, aren't those incremental margins going to get squeezed to death?
It is a highly valid concern. Commodity supercycles, where the price of raw materials skyrockets and stays elevated for years, have absolutely destroyed industrial balance sheets in the past.
If your input costs double and you can't raise your prices fast enough, your margins just vanish.
Right. But based on Todd Adams' response, the management team is not panicking. And the reason they aren't panicking loops right back to the supply chain optimization we spent so much time discussing earlier.
Oh, the China pivot is acting as a hedge.
Precisely. Because they have entirely rebuilt and optimized their supply chain base, their overall operational and logistical costs are actually coming down month over month.
So they're finding savings elsewhere to offset the copper.
Exactly. The structural savings they're generating from nearshoring, from negotiating better freight routes without massive trans-Pacific shipping costs, and from implementing those 5,000 plus continuous improvement ideas on the factory floor, it's all acting as a massive financial shock absorber.
So even if the raw price of copper goes up, the cost to shape that copper, ship that copper, and assemble it has gone down so drastically that the overall cost of the finished valve remains relatively stable.
Yep. They absorb the pothole in the road and the shareholder never feels the bump.
That's brilliant. They don't have to frantically raise prices and risk alienating their customers just because the commodities market's having a tantrum.
It provides them with incredible operational breathing room. And that breathing room directly informs their capital deployment strategy for 2026.
Because they have that $335 million of projected free cash flow sitting there.
And a pristine balance sheet. So management made it very clear that they are actively hunting for M&A, mergers and acquisitions.
But let's translate that M&A strategy. When they say they're looking for, quote, organic adjacencies in the North American professional plumbing and water space, what does that actually mean in plain English?
In simple terms, it means they want to buy companies that sell to the exact same people Zurn Elkay already sells to.
Give me an example.
Let's go back to the hospital facility manager. Zurn Elkay already has the relationship, right? They are already selling that manager the drinking fountains, the heavy-duty drainage pipes, the backflow preventers.
They're already in the building.
Right. The adjacency strategy asks, what other water-related products is that hospital buying from a different, smaller vendor?
Oh, I see. Maybe it's a specific type of surgical scrub sink or specialized thermal mixing valve.
Exactly. If Zurn LK can acquire that smaller company, they can take those new products and instantly run them through their massive optimized sales network.
And more importantly, they can run that newly acquired company through the ZEBS continuous improvement culture.
Yes. If they buy an inefficient competitor, plug it into their near-short supply chain, and apply their 42% pull-through efficiency, they instantly massively increase the margins of the acquired company.
It's an aggressive, highly calculated growth playbook.
And it's a playbook they have executed successfully in the past, specifically when they acquired and integrated their fire protection product lines years ago. They have the institutional muscle memory to do this without destroying shareholder value.
Which brings us to the most critical part of our deep dive. We've dissected the Q4 beat, we've unraveled the mechanisms behind the supply chain pivot and the recurring revenue filtration models, and we've stress-tested their 2026 guidance against commodity risks.
We've covered a lot of ground.
We have. So what is the bottom line? For the retail investor listening to this, analyzing their portfolio allocations, what is the talk ticker's verdict on the ZWS based purely on this source material?
Synthesizing all the data, the operational narrative, and the macro positioning. The verdict is unambiguously bullish.
I have to agree. You rarely see this combination of defensive positioning and aggressive operational leverage.
Right. We are looking at a textbook cash flow compounding machine. If you currently hold the stock or are evaluating an entry point, the central thesis revolves around the optionality provided by that 0.4 times leverage ratio.
Let's map out that optionality because in a volatile macroeconomic environment, a heavily indebted company is fragile. They are at the mercy of their creditors.
Totally.
But Zurn Elkay has the exact opposite problem. Management is sitting on a loaded bazooka of cash ready to deploy with virtually no debt burden. That gives them total, unencumbered flexibility.
It really does. Think about the scenarios. If the broader market enters a recession and the stock price takes an unwarranted dip, management has the cash ready to aggressively accelerate their share buyback program.
Buying their own stock at a discount and further shrinking the float.
Exactly. If they can't find a reasonably priced acquisition target, they have the cash flow to significantly increase that $64 million dividend, rewarding long-term holders.
And if a competitor stumbles, they have the dry powder to execute a major acquisition without needing to take on toxic high-interest debt.
It's a heads I win, tails I don't lose much scenario, and is driven entirely by their exposure to institutional construction.
Right, because you aren't betting your capital on the fickle nature of the consumer. You aren't hoping someone decides to buy a new 4-bedroom home at a 7% mortgage rate.
You are betting that a municipality will execute an already funded bond measure to replace a rusty 50-year-old water fountain in a public high school. The demand floor is just incredibly sturdy.
And that leads perfectly to one of the most fascinating structural advantages of this business, the regulatory moat.
Ah, the EPA rules.
Yes. Management has successfully positioned Zurn Elkay right in the path of federal clean water regulations, specifically the EPA's lead and copper rule improvements.
Which is massive.
These aren't suggestions, folks. These are federal mandates requiring municipalities and facilities to test for and remediate toxic infrastructure. Zurn Elkay isn't just selling a good idea, they're selling the legally mandated solution.
However, we need to be careful not to overhype the regulatory angle here.
Fair. What's the reality?
During the Q&A, an analyst asked if these new EPA rules were going to act as a sudden, massive accelerant for the stock, essentially asking if revenue was going to skyrocket overnight because of the mandate.
And what did management say?
Their response was wonderfully measured and realistic. They noted that there are currently 6 million existing drinking fountains installed across the United States right now.
6 million physical units bolted to walls that eventually need to be dealt with.
Exactly. And the EPA rules are incredibly helpful catalysts, but they do not create a sudden flash flood of demand where all 6 million are replaced in a single year.
Oh, right. Municipalities simply don't move that fast.
They don't. And supply chains couldn't handle the spike anyway. Instead, what the EPA mandate provides is a long, steady, predictable drumbeat of demand. It guarantees a reliable replacement cycle over the next decade.
And, from an operational perspective, a steady drumbeat is actually far superior to a sudden spike.
Completely.
If demand spikes unnaturally for a year, a company has to overhire, they have to overbuild factory capacity, and take on debt just to meet the rush. Then, when the spike subsides, they are left with massive overhead and plummeting margins.
The classic boom and bust cycle.
Right. But a steady, decade-long drumbeat allows them to scale efficiently. They can utilize their continuous improvement culture and just let the compounding math do the work.
It removes the volatility from the equation entirely. It is a very clean story of execution, margin expansion, and disciplined capital allocation.
But as always on Talk Tickers, we promise you a complete deep dive, turning over every single rock in the source material. And before we conclude today, I want to leave you with one final, highly provocative thought to explore on your own.
Oh, I know where you're going with this.
It was a tiny nugget buried at the very end of the Q&A session. It wasn't the main focus at the presentation, but it could be absolutely critical for the company's future growth trajectory.
The hidden data center play.
Exactly. Right now, the entire financial world is obsessed with the AI boom. Everyone is frantically buying semiconductor stocks, server manufacturers, software companies, pushing those valuations into the stratosphere.
NVIDIA, Microsoft, all of them.
Right. But what the market often forgets is the physical reality of these massive AI data centers. They run incredibly dangerously hot.
Yeah, the energy draw is insane.
To function, and to prevent catastrophic server meltdowns, they require vastly complex, heavy-duty liquid cooling and massive water management systems.
And during the closing moments of the call, an analyst actually asked management directly about their exposure to this vertical.
And what did they say?
Management confirmed that while it isn't their largest revenue segment yet, their orders tied specifically to data center construction are visibly accelerating as they exit 2025.
Which is a huge tell. Now, to be clear, Zurn LK does not manufacture the HVAC chillers or the high-tech liquid cooling servers themselves.
No, that's not their game.
But they supply the critical infrastructure that surrounds it. The heavy-duty valves, the backflow preventers, the complex drainage systems, and the precise water control mechanisms that make the tooling systems legally and functionally viable.
Think about the implications of that for a second.
It's a massive.
While the rest of the market is fighting over wildly overvalued, highly volatile tech stocks, Zurn LK is quietly capturing a highly profitable, deeply necessary slice of the multi-trillion-dollar AI infrastructure build-out.
They're selling the literal plumbing for the artificial intelligence revolution.
That is exactly what it is.
It is the ultimate backdoor play on the future of technology, wrapped inside a boring industrial manufacturing stock.
And it really highlights why reading the entire transcript right down to the final analyst question is so vital. You uncover these adjacent growth engines that just aren't captured in the headline press release.
And it brings us full circle to why we do this show. When you just look at the ticker symbol flashing red or green on a screen, you miss the mechanics.
You miss the story.
You do.
Yeah.
But when you tear into the actual business, when you understand how a proprietary filter head creates recurring revenue, how moving away from China protects profit margins from tariffs, and how 5,000 tiny factory floor improvements compound into record cash flows, you stop gambling on stock prices and start understanding wealth creation.
Beautifully said.
Thank you. And thank you, the listener, for joining us for this Talk Tickers deep dive into Zurn LK Water Solutions. We hope we've helped translate the Wall Street noise into actionable clarity for your portfolio. Stay curious, keep reading the footnotes, and always look beyond the headline numbers. We'll see you on the next deep dive.